It also took about 57 days for it to make a new 5% deviation high. So we can't be waiting 58 days before we know a high is made, which of course, take note, is it has to also count another 5 candles forward. So that would be like 58 plus 5, making it 63 days. So you have to literally wait 63 days to see it tell you, oh, we just made a new high, or oh, we just made a new low. That's a lot. So using this to print out market structure on the higher and the lower time frame is what it is used for. For example, this particular stuff being shown here is most likely telling me the monthly or weekly structure of the market, because let's check it out. If we go up to the weekly, you can see it takes a long, it becomes smaller because it's now taking account of that 5% change. And now take note, 5% change in price in a week is not a lot, but for price to move 5% in a day, that is a lot. Let's take a good look at this. I want you to take your eyes to the top left corner of the screen, where we have the open, high, low, close, and percentage deviation, and also price movement. I actually like to see that whole information there. You can see price moved by, over here, price moved by 6.11% in a week. Take note, these are weekly candles in 1 week. Now that is a huge move in 1 week. So if 6.11% is a huge move in 1 week, then you looking for 5% on the daily time frame is you looking for too much. Meaning finding 5% in just 1 day, that is absolutely wild. So what does that mean? It means I'm going to look at all these candles one after the other, and I'm going to say, what is the average move? And that's where ATR comes in, but I do not want to use ATR in this video.